In all my years studying the markets, measuring angles, tracing time cycles, weighing price against its own history, I've seen one truth surface again and again. The market punishes carelessness far more swiftly than it rewards discipline. And if there is one error that can erase a month of steady gains, it is the error of violating your own rules. You may have felt that sting yourself. Have you ever watched a single impulsive trade undo weeks of careful work? When I speak of rules, I don't mean the rules the market gives you. The market gives none. I mean the rules you carve out through study, patience, and observation. A trader must know his own boundaries as well as he knows the angles on his chart. If you know that a certain level is your stop, why shift it after price has already moved against you? Doesn't that shift your mind from calculation to hope? I've said many times, hope is a luxury the trader cannot afford. Often it is not the system that fails, but the trader who abandons it at the worst possible time. A month of wins is the product of discipline, and discipline is always built trade by trade. You compound your knowledge the same way you compound your capital, slowly, deliberately, without reckless leaps. But when the mind becomes impatient, when it wants the market to move instead of reading how it moves, that is when losses expand. Have you ever noticed how losses come larger when emotions sit at the table? Most great mistakes begin with a small deviation. A trader ignores a signal, or enters before time confirms the trend, or holds a losing position just a little too long. What is a little? A little becomes much when multiplied across time. I spent decades measuring market movements and discovered that the smallest misjudgments often grow into the greatest losses. The market is not cruel. It is simply consistent. It will reflect back to you the exact nature of your habits. If your habits are careless, the results will show it. Doesn't the chart always reveal more about the trader's mindset than he expects? You must remember every trend has its reaction, every price swing has its counterpart, and every market cycle repeats in its own rhythm. Your task is not to conquer the market, but to understand its order. And 1 month of winning trades usually means you were in harmony with that order. You observed, you acted calmly, you stayed within the law of probability, but one reckless error breaks that harmony. It is like drawing a perfect geometric figure and then disrupting it with a careless mark. The symmetry is lost. Have you ever looked back at a bad trade and thought, I knew better, even as you placed it? Fear and greed are the two forces that destroy more accounts than bad analysis ever will. When you're winning, greed whispers that you've mastered the market. When you're losing, fear urges you to abandon the plan. Both lead to the same result, deviation. I have seen traders who gained for weeks only to lose it in a single afternoon because they believed the trend must continue. The trend must do nothing. The market responds only to supply and demand, time and price, strength and weakness. The trader who respects these forces grows his capital slowly and steadily. The trader who argues with them pays for the lesson. And haven't you noticed that the market collects tuition immediately? Wealth building in trading is not a matter of catching every move. It is the work of preserving capital and growing it with consistency. Each trade should serve that purpose. A month of wins is a sign that you've been aligned with your method. It is proof that your rules work when followed. But a single violation of those rules means the method was abandoned. That is the true error, not the loss itself, but the breach of discipline that allowed it. Ask yourself when you look at the last trade that hurt you, was it the market that failed, or did you step outside your own guidelines? A trader must learn to read the chart as one reads a map. The angles, the trend lines, the levels of support and resistance. These are not decorations but tools. They are the lines that show you where the market has been and where it is likely to go. When you follow them, you protect your capital. When you ignore them, you gamble. Too many traders mistake gambling for boldness. The bold trader acts with knowledge, the gambler acts from impulse. And if impulse has ever taken over your decision-making, did it not cost more than you expected? Time is another factor most traders neglect. I've said before that time is the most important element in forecasting. You must know not only how far price can move, but when it is likely to move. If you enter at the wrong time, even the right direction can bring losses. And when losses come after a month of gains, they strike at both your account and your confidence. Confidence is a fragile instrument. Once shaken, it leads traders to chase trades, double positions, widen stops, all the errors that erase what was earned through patience. Have you ever seen how quickly confidence can vanish after a single poor decision? A trader should always think in terms of preservation first, profit second. Profits follow those who guard their capital as a farmer guards his seed. It takes time, care, and respect for natural cycles to produce a harvest. Trading is no different. The market gives opportunities, but it also tests your resolve. It asks whether you will follow your rules under stress as faithfully as when conditions are calm. And when you fail the test, even once, the cost can be the entire month's progress. Yet the market is fair. It gives you the chance to correct course on the very next bar. But do you take that chance or do you linger on the mistake? Each loss should be studied, not mourned. You must trace it back to its origin. Did you follow your price rules, your time rules, your risk limits, or did you let emotion override structure? These questions rebuild a trader's foundation. They force you to confront your habits. Wealth in trading comes not from brilliance, but from the steady refinement of those habits. And though one error can erase a month of wins, one correction in your process can prevent it from happening again. When I mapped markets using geometric angles and time cycles, I learned that every mistake pointed back to a moment where I failed to obey my own instruction. The market followed its law, I had deviated from mine. And that is why I warn every trader, guard your rules more fiercely than your opinions. Your opinions may be wrong, but your rules protect your capital. When you break them, the market responds immediately. Have you ever noticed how quickly the market teaches a lesson when discipline slips for even a moment? And so we return to that single error that can undo an entire month of careful trading. It is not hidden, mysterious, or complicated. It is simply the error of stepping outside the structure you built for yourself. Breaking your own trading rules is the fastest path to wiping out consistent gains, and every trader eventually learns this truth in a very personal way. When you build rules, whether they're based on price levels, time cycles, risk limits, or chart confirmations, you're really building a protective structure around your capital. Those rules don't exist to restrict you, they exist to keep you alive in the market. Yet the moment a trader steps outside that structure, the market wastes no time delivering consequences. Think back to your own trading journey. Haven't the most painful losses come from moments when you knowingly ignored your plan? Most traders assume large losses come from bad market conditions or sudden volatility, but far more often they come from the human tendency to believe, just this once won't matter. But just this once is exactly how a month of progress disappears. Rules act like guardrails. When you cross them, you enter a space where hope, fear, and impulse begin making decisions instead of analysis, timing, and logic. And once you're in that emotional zone, even a small price movement against you can turn into a significant loss because you're no longer acting, you're reacting. Have you ever noticed how quickly your thinking becomes cloudy the moment you abandon your original plan? Consistency in trading does not come from winning big, it comes from maintaining discipline through every phase of the market. When you stick to your rules, even your losing trades serve their purpose because they're controlled, expected, and limited. They're part of a long-term process. But when you break your rules, losing trades become wild cards, unbounded, unpredictable, and often far larger than any winning trade from the previous month. That imbalance is what destroys accounts over time. You might even remember a trade where you entered without confirmation, held past your stop, or added to a losing position thinking it would bounce soon. Did that trade respect the boundaries that you set to protect your capital? The reason broken rules are so dangerous is that they remove the one element a trader can control: risk. The market controls everything else: direction, volatility, timing, momentum, reaction to news. But your rules determine how much you expose yourself to those forces. Once you violate them, the market takes complete control. And the market is neutral. It doesn't care whether you've had a great month or whether you need one more win. It simply responds to supply and demand. If you're on the wrong side of that interaction and you've broken your rules in the process, the losses can escalate far faster than expected. Isn't it strange how quickly a calm trading month can turn chaotic when discipline wavers? Every trader experiences temptation. Temptation to enter early, to chase a sudden move, to widen a stop because the trend still looks good, or to double a position because the last few trades went well. But high probability setups don't come from temptation, they come from structure. Structure is what keeps your analysis rooted in reality instead of emotion. When you break your rules, you trade against your own knowledge. It's like having a map and choosing to walk off the marked path simply because the unmarked ground looks interesting. How often does that lead anywhere productive? The truth is that your rules reflect hours, months, even years of study. They represent mistakes already made, lessons already learned, and patterns already tested. Violating them is like disregarding that entire history for the sake of a momentary impulse. This is why one rule, breaking trade, can do more damage than 10 losing trades that follow your plan. Losses inside your plan are part of the statistical curve of trading. Losses outside your plan disrupt that curve entirely. Have you ever realized how differently you emotionally handle a loss taken with discipline compared to a loss taken in frustration or impatience? Traders who break rules often do so because they believe they see something new on the chart, some sudden shift, some signal they think others are missing. But the market rarely rewards improvisation. Most of the time, these impulses are emotional disguises, not true insights. The chart may show a quick spike or a sharp movement that makes you want to act, but real trading strength lies in waiting for confirmation, waiting for setups, waiting for price to reach your level. Patience is part of the rule set. Breaking rules is often the opposite of patience. It is an attempt to shortcut the process. And what happens when shortcuts are taken in trading? The long path to rebuilding begins. Another danger of breaking rules is that it trains your mind to view discipline as optional. Even if the rule, breaking trade, happens to win, which sometimes it does, the psychological cost is enormous. It reinforces the belief that intuition or impulse is just as reliable as a tested system. Then the trader begins to drift. They trade more aggressively, enter without confirmation, increase size beyond their plan, and eventually encounter the inevitable trade where everything goes wrong. The damage from that one trade is magnified because the trader had been rewarded earlier for taking the same kind of undisciplined risk. Have you ever felt how dangerous a lucky win can be? Your trading rules aren't there to make you comfortable. They're there to make you consistent. And consistency is a trader's greatest asset. A month of wins is evidence of following structure. Losing that progress in a single day is almost always evidence of abandoning it. The market doesn't erase your gains. You do, the moment you decide your own guidelines no longer apply. Rules don't guarantee profit, but they guarantee protection. When you break them, you trade unprotected, exposed to every fluctuation, every emotional reaction, every misleading price swing. One impulsive trade can undo weeks of disciplined decision-making, and the frightening part is how quickly it happens. A trader may spend an entire month choosing careful entries, respecting stops, following signals, and managing risk with precision, only to watch one sudden lapse erase the progress built through dozens of thoughtful actions. It doesn't feel fair, but the market is never concerned with fairness. It only reflects the choices you make. And an impulsive trade is a choice born not from analysis, but from emotion. Have you ever looked back at a trade and realized, almost instantly, that it had nothing to do with your plan? Impulsiveness in trading usually appears in disguise. Sometimes it shows up as excitement after a winning streak, where a trader feels invincible and decides to take a trade that isn't fully confirmed. Other times it emerges from frustration with a recent loss, pushing the trader to jump into the next setup too quickly, trying to make it back before thinking clearly. Or it can come from simple impatience, when the market seems too slow and the trader wants to feel active again. Whatever form it takes, the pattern is the same. Logic steps aside and emotion takes the wheel. And once emotion is steering, even a minor market fluctuation can cause outsized damage. Have you noticed how the worst decisions often come when you feel pressure to do something rather than wait? Weeks of disciplined trading create a rhythm. You enter only at your levels. You wait for signals you trust. You manage your size with awareness, and you exit according to your plan. This rhythm builds consistency, not just financial consistency, but mental consistency as well. You begin to trust your process. But impulsive trades break that rhythm instantly. The moment you enter without confirmation, without alignment to your method, your mind becomes unsettled. You know you've stepped outside the structure you rely on. That internal conflict creates stress, and stress leads to more imbalance in your decision-making. Have you ever felt your confidence shift the moment you realize you acted too quickly? An impulsive trade has a unique ability to spiral out of control because it often triggers a chain reaction. If the trade goes wrong, many traders hesitate to exit because they feel ashamed that they broke their rules. Instead of cutting the loss quickly, they hold on to it, hoping it will return to their entry. They widen the stop or remove it entirely. They begin to rationalize the mistake. It's just a small pullback. Or, the trend will resume. Or, I'll give it a little more room. But these thoughts don't come from analysis. They come from regret. And regret is one of the most dangerous emotions in trading. Have you ever seen how hope tries to replace discipline right after an impulsive mistake? Even if the impulsive trade wins, the danger isn't over. A winning impulsive trade can be more destructive to a trader's mindset than a losing one, because it teaches the wrong lesson. It tells the mind that breaking structure sometimes pays off. That small taste of reward encourages future rule breaking. The trader begins entering without full confirmation more often. They begin believing they can feel the market instead of needing the chart to support the decision. Weeks of careful discipline are gradually replaced by spontaneous actions, all because one impulsive win planted the seed that discipline is optional. Have you ever felt tempted to repeat a behavior simply because it worked once? The real danger lies in how fast an impulsive trade can offset a long string of good decisions. A month of solid trading might include 20, 30, or more carefully managed trades, each with a controlled risk. But an impulsive trade is rarely controlled. Traders tend to size it too large, enter too late, or stay in too long. It often carries more risk than all the disciplined trades that came before it. That imbalance is why one impulsive moment can wipe out everything built over many days. It's not the market that destroys the progress. It's the loss of structure, the shift from logic to emotion. Have you ever realized how uneven the scale becomes when discipline is consistent but impulsiveness is extreme? Another subtle danger is how impulsiveness distorts perception. When a trader takes an impulsive trade, they often watch the market differently. The price movements feel more personal, more threatening, more dramatic. What would normally look like a simple retracement suddenly feels like an attack. What would normally be a calm consolidation feels like a trap. This altered perception leads to further errors, premature exits, rushed re-entries, overtrading, or freezing when action is required. Discipline produces clarity, impulsiveness clouds it. Have you noticed how differently you read a chart when your entry was planned versus when it was rushed? An impulsive trade also damages the trader's long-term confidence. Confidence in trading isn't built from winning trades alone. It comes from knowing that your victories were earned through process, not luck. When you act impulsively, even if the outcome is neutral, you weaken your trust in your method. And once trust fades, hesitation begins. You start second-guessing your setups, entering late, skipping trades you should take, or abandoning strategies that were working simply because your mindset shifted. A single impulsive decision can echo through many future trades, shaping your behavior long after the initial trade is closed. Have you ever found yourself hesitating on a good setup because you were still thinking about a past mistake? This is why traders must always remain aware of their emotional state. Impulsiveness thrives in moments of excitement, frustration, boredom, or fear. Recognizing these moments allows you to step back before acting. Just a few seconds of awareness can prevent a decision that may cost weeks of steady progress. The disciplined trader asks, "Is this my setup?" While the impulsive trader asks, "Can I make something happen here?" The difference between those two questions is the difference between steady growth and sudden setback. And the market always exposes the difference through results. One impulsive trade can undo weeks of disciplined decision making because impulsiveness doesn't just affect the trade you enter. It affects your psychology, your process, your future decisions, and the integrity of your system itself. And once that integrity cracks, the consequences unfold swiftly. Moving stops out of fear or hope is the most costly trading error, and every trader eventually learns how dangerous that small decision can be. A stop loss is not just a protective order on a chart. It is a boundary you set for yourself, a line that separates discipline from emotional trading. The moment you move a stop after price pushes against you, you're no longer following your plan. You're negotiating with the market, and the market is never interested in negotiating. Have you ever found yourself dragging a stop lower, telling yourself you're just giving the trade little more room? When you set a stop before entering a trade, you do it with a clear mind. You are thinking logically, assessing risk, analyzing structure, and choosing a level that invalidates your idea if price reaches it. In that moment, you're rational. But once the trade is live and price moves against you, emotions start to speak. Fear shows up, whispering that the stop might hit before price turns. Hope answers, suggesting that you should widen the stop because the market just needs a moment to breathe. But these emotions have no place in risk management. They don't know the chart, the trend, or the structure. They only react, and reacting is the opposite of trading. Have you ever noticed how fear and hope suddenly sound convincing when the market moves a few ticks in the wrong direction? A stop loss represents your maximum acceptable loss for a trade. When you move it, your acceptable loss expands. Not because the setup improved, but because your feelings changed. That shift is what turns manageable losses into damaging ones. A trader who keeps stops fixed knows exactly where risk ends. A trader who moves stops no longer has a risk limit. From there, losses can grow much faster than planned. That's why this one mistake often causes the largest drawdowns. It's not because the trade was bad. It's because the trader changed the rules mid-trade. How many times has moving a stop actually saved you, compared to how many times it made things worse? The most dangerous part is how subtly moving a stop becomes a habit. You might do it once thinking it's harmless. Then you do it again because the market almost turned last time. Before long, you become a trader who sets stops only as a suggestion, not as a rule. The discipline that protected your capital for months slowly dissolves. And when discipline fades, consistency follows. Every strategy works only when followed precisely. Changing stops changes the entire strategy in unpredictable ways. Have you ever realized that once you move a stop, you can no longer trust the data behind your system? Moving a stop is also a psychological burden. Once you shift it, you know you've violated your plan. Even if the trade eventually wins, the internal damage is already done. You taught your mind that breaking rules can be rewarded. The next time the market pressures you, that memory returns, making it easier to justify another stop adjustment. Little by little, discipline erodes not through failures, but through small emotional compromises. And when the big loss eventually comes, it often lands on a trade where you should have accepted a small, controlled loss but instead turned it into a large, uncontrolled one. Have you ever stared at a loss and thought, if I had kept my original stop, this would have been a normal trade? Another danger of moving stops is how it reshapes your relationship with the chart. When you plan a trade, your stop is placed based on structure, perhaps below a swing low, outside a trend line, beyond a key level of support or resistance. When you move it, you often place it somewhere that has no technical meaning, simply because you want more room. That means your stop is no longer aligned with the chart. You're no longer trading based on analysis. You're trading based on discomfort. And once your stop loses structure, your trade loses structure. Have you ever caught yourself placing a stop in a spot you knew wasn't strategic? Traders often say they move stops to avoid getting wicked out, but this belief is usually just fear in disguise. A wick is part of the price story. If price touches your stop, your idea was wrong, at least for now. But many traders can't accept being wrong, so they move the stop to postpone the emotional discomfort. But postponing discomfort almost always increases financial damage. It is far better to take a small, planned loss and enter when conditions improve than to hold a sinking trade out of refusal to accept being incorrect. Have you ever noticed how expensive it becomes when you try to avoid a small, normal loss? Hope is another silent enemy in stop moving. Hope convinces you that the market is about to reverse, that the trend is still valid, that you just need to give it one more level. But hope is not a strategy. Price doesn't reverse because you want it to. The market doesn't see your position, your emotions, or your needs. It simply moves according to supply and demand. And by moving your stop, you place yourself in direct conflict with those forces. You hold a position that the market is actively moving against. How often has hope ever been enough to turn a losing trade around? A fixed stop frees your mind. You know the maximum damage, and that acceptance allows clarity. A moved stop traps your mind. You don't know the limit anymore, and that uncertainty leads to stress, second-guessing, over-monitoring, and fear-driven decisions. The trader who keeps stops firm maintains mental energy for future setups. The trader who moves stops drains that energy quickly. Have you ever felt the emotional exhaustion that comes from managing a trade gone wrong because you refuse to exit when planned? Emotional trading grows losses faster than bad analysis ever will, and this is something traders often discover only after the damage is already done. You can recover from a poor read of the market, because a poor read still comes from a place of structure. You saw something on the chart, made a decision based on a method, and the trade simply didn't work out. That's normal. But emotional trading has no structure, no method, no system behind it. It happens when your feelings override your rules, and once that switch flips, losses can escalate with surprising speed. Have you ever watched a losing trade get worse simply because you hesitated to act when you knew you should? The danger is that emotions do not arrive with a warning. They slip in quietly, often disguised as logic. Fear poses as caution. Greed pretends to be confidence. Frustration masquerades as urgency. Impatience tries to convince you that waiting means missing out. These emotions don't announce themselves. They guide your thoughts until you believe the decision is rational, even though it isn't. This is why emotional trading becomes so costly. You don't always realize you're doing it until the damage is growing in front of you. Has there been a moment when you clicked into a trade quickly, only to question it seconds later? Fear is one of the strongest forces in trading. When price moves against you, fear can cause instant reactions, closing too early, widening a stop, reversing positions impulsively, or avoiding valid setups because you're afraid of another loss. Fear shrinks your trading vision. Instead of seeing the chart clearly, you focus on the pain of the current position. And when your focus narrows like that, your decisions become distorted. You stop reading levels and start reading your emotions. That's when normally manageable losses expand. You might exit too soon, only to watch price move back in your direction. Or you might freeze and refuse to exit at all, hoping things improve while the loss grows larger. Have you ever felt that tightening in your chest when a candle moves too fast, causing you to act before thinking? Greed is the opposite side of the emotional spectrum, but it's just as destructive. Greed tells you that a winning trade should turn into an even bigger one, even when the chart doesn't support it. It makes you ignore exit signals. It encourages you to increase your position size because the last few trades went well. It tells you that momentum will keep pushing simply because you want it to. But the market doesn't reward wanting, it rewards structure and timing. Greed blinds you to both. And when you're blinded, you hold too long, add too much, or jump into trades that aren't even setups. Then one reversal wipes out the wins that greed whispered wouldn't matter. Has greed ever convinced you to hold? Just a bit longer, until you watched the candles turn suddenly against you. Frustration is another hidden danger. A trader who feels frustrated, perhaps after a losing streak or a missed opportunity, starts trading with the intention to strike back at the market. This is one of the most dangerous emotional states because it drives overtrading. You take trades simply because you want something to happen. You push entries, you force setups, you try to accelerate recovery. But recovery never accelerates through emotional decisions. If anything, frustration multiplies losses because every frustrated trade comes from a mindset disconnected from strategy. You're no longer reading the chart. You're trying to fill an emotional gap, and the market doesn't fill emotional gaps, it exposes them. Have you ever taken a trade knowing deep down it wasn't a real setup, but you just couldn't sit still? Impatience is perhaps the most subtle emotional force. It strikes when the market is quiet, when price moves slowly, or when you feel that you've been waiting too long for an opportunity. Impatience convinces you to take subpar entries, to skip confirmations, to enter early because who's close enough to your setup? But close enough is not confirmation, and entries taken without confirmation often behave like unwanted surprises.